Selling items off a dollar menu while operating in volatile economic conditions suggests razor-thin margins. Yet, this company consistently generates over $10 billion in operating cash flow every year. Securing that kind of stability requires meeting broad financial objectives. Businesses achieve this by manipulating four distinct strategic levers: cash flow, working capital, profitability, and global management. We are going to deconstruct the McDonald's corporate structure to see exactly how these textbook concepts function in the real world. The interplay between these four strategies determines whether a business struggles to pay rent or scales into a resilient global operation. Cash flow management is the strategy of timing the exact moment money moves into and out of the business. Typical methods include distributing payments over time, offering discounts for early payment, or factoring, selling accounts receivable to a third party. McDonald's ignores factoring. Instead, they rely on strict contracts requiring their franchisees to pay royalties by the 10th of every month. This guarantees massive, predictable, upfront cash inflows. Working capital management is the control of current assets and current liabilities to maintain safe liquidity. For McDonald's, this means keeping enough short-term assets to comfortably cover short-term debts, reflected in their healthy current ratio of 1.43 to 1. To control their current assets, specifically their inventory, they use a first-in, first-out system combined with AI-driven ordering. By assembling burgers only when ordered, they eliminate wasted stock in the kitchens. For current liabilities, they manage potential shortfalls by maintaining a $3.5 billion overdraft facility. They rarely draw on it, keeping it strictly as a standby safety net. When acquiring property, they utilize leasing to minimize initial capital outlay, but they strictly refuse the strategy of sale and leaseback. They own the land under thousands of their franchise stores, and holding that real estate is the foundation of their long-term wealth. They utilize precise cash flow timing to fund their daily operations, while deploying massive real estate holdings and overdraft facilities to secure their working capital. Profitability management looks past immediate bills. It focuses on the long-term balance between minimizing costs and maximizing revenue controls. At the individual store level, they face fixed costs like insurance and variable costs like food and packaging. Their made-to-order assembly system directly targets those variable costs, cutting down daily physical waste. This pie chart illustrates their revenue controls at the corporate level. McDonald's franchises 95% of its locations. This shifts the operational risk of running a restaurant away from corporate, securing highly predictable, high-margin rent and royalties instead of relying on burger sales. Profitability strategy is about redesigning the revenue structure to shift risk away from the core business. Operating in over 100 countries introduces global financial management. International revenues expose the company to volatile exchange and interest rates that can erase profit margins. Hedging is the overarching defensive strategy used to minimize this financial risk. Derivatives, like cross-currency swaps and options, are the specific financial instruments used to build that defense. McDonald's creates a natural hedge by borrowing money in local currencies. They back this up with cross-currency swaps to protect their profits against fluctuations in the US dollar. Pause here for a moment. Imagine a franchisee has no cash to buy new kitchen equipment and beef prices are spiking. Name one working capital strategy and one profitability strategy to solve this. For the equipment, the working capital strategy is leasing. For the beef prices, the profitability strategy is cost controls through expense minimization. Global financial management acts as an invisible shield. It ensures the operational profitability earned at the store level isn't wiped out by external economic variables. Expert financial management requires selecting the specific strategies that align with a business model, rather than attempting to use every tool in the syllabus. McDonald's ignores factoring and sale and leaseback, yet heavily utilizes derivatives and cost controls. The choice depends on the specific friction the business faces. For exam scenarios, first diagnose which of the four quadrants a business is struggling with. Then, recommend a strategy from that box. Mastering these four quadrants gives financial managers a framework to sustain growth and protect margins in any economic climate.